All right, welcome back. This is Abiodun Adelu, and we're still talking about investment and finance. Now, when it comes to discussions about investment, there is something that almost nobody pays attention to, and that is the matter of taxes. Most investment conversations focus on returns, profits, growth, and opportunities. But there is a very important question that many investors usually forget to ask. And the question is that, how much of this return do I actually get to keep? Because investing is not just about making money. It's also about understanding what happens after the money is made. So let's imagine two investment options. Let's say that investment A earns 15% and investment B earns you, let's say, 13%. So, just looking at it on paper, investment A, which is 15%, looks more attractive to you, right? Most people immediately would choose investment A, isn't it? But what if investment A attracts significantly higher taxes than investment B? So what if investment B allows you to keep more of your returns? Suddenly the answer becomes less obvious, right? And that is why smart investors think in terms of after-tax returns, not just the returns, after-tax returns. Even in business, you talk about profit after tax, because you can have a huge profit before tax and your profit after tax is still lower. So what is tax? Tax is simply the portion of your income, your profit, your gain that may be payable to government under applicable laws. That is what tax is. The portion of your income, the portion of your profit, the portion of your gain that you have to pay to the government under applicable laws. So as investors, taxes are not something to fear. You don't have to fear tax. They are simply something to understand. So think of taxes as one of the costs of participating in an economy. Just like your transaction cost, your management fees, your inflation, and other costs. So tax is also one of the cost of participating in an economy. So all investors need to understand tax. They need tax awareness. And notice that I said awareness, not obsession. So you don't need to become a tax consultant. You just need to know enough to avoid surprises, because nothing feels worse than expecting one return and discovering later that taxes reduce what you actually receive. Okay, let's move on. One of the reasons that taxes is an important conversation is that not all investments are treated in the same way. Okay, so for example, let's look at some of the income that you earn. Let's say your employment income. The salary you earn is typically subject to tax, right? I'm sure that you know that. So employment, your salary is subject to tax. Business profits is also subject to tax, right? So you have different tax obligations that you pay. Rental income, if you are renting out your property and you are getting income from it, you have tax obligations. So there are tax implications to it, and you need to know about it. What about your dividend? Shareholders who receive dividends may encounter withholding taxes depending on the jurisdictions and applicable rules. It's always necessary to find out about what is obtainable in your country and what is applicable to the specific type of investment you're making. And we also have interest income. So if you are earning interest from certain debt instruments, like the treasury bills, bonds, and all of those things that we talked about earlier, they may also have some tax considerations. So it is important for you to know it. And the details vary by country, and sometimes they also change over time. So that's why I can't give you a specific number and I can't give you a specific detail, because by the time you are listening to this, it's possible that it has changed from what is obtainable now, and your country may also be different. So if you are listening from Ghana, for example, or you are listening from Sierra Leone, or you are listening from maybe from Canada, or you are listening from Australia, we have different tax implications for all of those countries. So that is why investors should periodically stay informed about what is happening in the financial world generally. Now, let's use Nigeria as an example. So if you are investing in Nigeria, one of the most important habits that you can build is keeping proper records of everything you are doing. Keep records of your purchases, all the things you're buying, keep records of them. Keep records of your sales. Keep records of your dividends, the dividends you receive, the interest you receive, and your investment statements. Keep all of those records. Good records make compliance easier and reduce confusion later. So there was a recent tax reform in Nigeria, for example, and it became effective this year. So there's a need for everyone that is interested in investment. In fact, if you are making any income of any sort, for you to be interested in what is happening. So even if you are not aware of it, it is still binding on you. So it is important to take some time to read up on the tax laws and how it affects your income. So most times we spend hours researching investment, but we spend almost no time understanding taxes, regulations, and reporting requirements. So, and when it is now time for the tax obligation, when they arise, we become frustrated. So in Nigeria today, you can't stay outside the tax radar for long. So it is better that you understand the tax implications of your investment decisions and you begin to make adequate preparation for it. A mature investor doesn't just stay at understanding opportunities, they also try to understand their responsibility. So they study both opportunities and the responsibility for taking advantage of those opportunities. Of course, it's also important that you don't make an investment decision solely because of tax benefits. That, okay, the reason why I'm choosing this is because of tax benefit. No. Why? Because a bad investment with good tax treatment is still a bad investment. So investment must make sense first before you now start looking at the tax treatment as a secondary thing. And another principle that is important is that you should never assume that because an investment is online, digital, or international, or modern, that taxes do not apply. Most people assume that foreign investment or online income or digital assets or cryptocurrency gains, that somehow they exist outside the tax radar. But that may create problems for you in the future. By the time you begin to see your tax obligations and you've not been keeping your books all the while. So always understand the applicable rules where you live and where you invest, and always make sure that you consider practical questions such as, number one, how is income from this investment taxed? Because different investment classes, different kind of instruments are taxed different ways. So you need to understand how income from that kind of investment portfolio is being taxed. And how are gains from this investment taxed? What records should I keep? And are there reporting obligations that I need to pay attention to? And what happens if I eventually sell my investment later? So don't get yourself overwhelmed with all these questions, but you just need to, you don't need to have answers to all of them immediately, but you should know the questions and you should begin to pay attention to them. So what tax teaches us is that the goal is merely not to maximize return, the goal is to also maximize retained wealth, and there's a difference between that. So it is not just about what you earn, it also matters what you keep. And you need to understand that taxes are a normal part of investing. People that are from high income countries, they're already used to conversations around taxes. They know that these things are normal, so they should not scare you. For some people that are from some African countries where they can even stay outside the radar of taxes for a long time, they may begin to get concerned, what is this one? So it should not scare you, but you should also not ignore it. You just need to understand it and begin to know how to prepare yourself for it. So a good investor learns how investments are taxed and how to keep proper records and how to remain compliant and how to evaluate returns after taxes. Because investment is not just about growing your wealth, it's also about managing wealth responsibly. So throughout this series, we'll focus mainly on financial assets, businesses, and traditional investments. But we are living in a digital economy. So today, people are creating wealth from assets that don't even exist on a shelf. They don't exist in a building, and they don't exist in a brokerage account. You hear of digital products, digital intellectual property, digital distribution, and that's exactly what we're going to talk about next. So beyond the traditional assets, businesses, financial assets, beyond those things, let's also look at digital assets. That's what we're going to be looking at in the next episode. Make sure that you listen to that. See you in the next episode.